This is finally in terms of how these categories have performed. As you can see, in the very short term, these categories can be very, very different, right? For example, last 1 year, Nifty 50 returns are at about 26%, but focused funds, by taking concentrated bets, have given about close to 38, 39% returns. Similarly, sectoral funds and thematic funds have also given superior returns on a 1 year basis. Now, within sectoral funds, probably technology fund has not delivered, probably banking fund has not delivered, so, but maybe there are other sectors which have delivered, other themes which have delivered. Example, infrastructure theme or a manufacturing theme has done better. But at an average level, sectoral funds have done much better than Nifty 50. Now you also move towards the 7 year, 10 year period, you will realize that whether you look at Nifty 50 or focus funds, sectoral funds, thematic funds, on an average, they all move towards that market return. Because over the 10 year period, certain sectors would not have done well, certain would have done average, certain would have done really fantastic. But net, what you are trying to do is over a 10 year period, you would have seen all ups and downs, and then your returns are going to be towards the market level. So if you are investing for 10 years plus, I don't think you can expect a very, very large deviation from a diversified fund from these categories. Very unlikely that a particular theme or a sector will continue to remain dominant for 8, 10 year period. But if you choose your entry and exit, as you can see from shorter term returns, 1 year, 3 year returns, there is a potential that you can get higher returns, but obviously, as I mentioned, at the cost of higher risk. So, friends, these were the points that I wanted to discuss during this half an hour. I'll be happy to take your questions if there are any. Thank you so much. Over to you, Paisa.
Lovely presentation. It was very, very detailed, and I'm sure everyone present over here, gained a lot from what you said and the data that you shared and the information that you shared. I have a few questions for you, which will basically, which I'm hoping, would help our personal finance professionals implement some of the things or many of the things that you said in your presentation in their daily practices. Let's move on to thematic and sector funds. At the very basic, I just want to get this thing out of the way. Who exactly should thematic funds and sector funds be recommended to? What sort of an investor profile, if you can give some kind of guidance to our personal finance professionals, should every investor, should every client of theirs be suggested or recommended a thematic and sector fund, or is there a particular profile that you feel should fit the requirements of what a thematic and sector fund investor should have?
Keza, the one clear differentiation that we need to highlight here is all the three categories that I spoke about, it's not for first-time investors, because the first-time investors will not understand the nuances of these categories. So when you come into the industry, probably you come with a slightly lower level of risk tolerance and a lot of hesitancy, a lot of question marks in your mind in terms of how each event will play out, etc. So it's better to come in the funds which are more diversified, which are less on risk profile. But once a person has seen a particular cycle, maybe 3-5 year cycle, then there is a little bit of better understanding in terms of how these cycles work. And they will also be a lot more tolerant in terms of if something goes wrong, why it has gone wrong, and they will appreciate that and probably move on. So in that sense, I would say any investor who has made certain investments in the equity market for a certain amount of time will be better equipped to handle the potential risk from these categories, and also will appreciate the nuances of this category better. So I would say a little bit more informed investors would be the ones who should be targeted for this.
There are lots of, I appreciate the fact when you're saying that, you have to have a sizable mutual funds portfolio experience and time spent in the markets for you to be able to appreciate thematic funds and sector funds better. But, especially since the onset of COVID times, Harsha, we've seen a lot of young investors, people in early 20s coming in. Initially, the wave of these young investors from, when we all switched from work to office to work from home, they opened up a lot of demat accounts, started trading in stocks and all. At that time, cryptocurrencies also became very popular. So the general risk taking capacity of youngsters basically just shot up because the number of new investors and new young investors also who are coming in also shot up. Now, these guys have never seen a bear market. Many of them have never seen a bear market before. So, when these kind of young investors come into the mutual fund fold, do you think even they also should stay away from sector funds and thematic funds? And how can personal finance professionals contain them, restrain their risk-taking capacity, at the same time entice them to invest in mutual funds, stay invested for the longer period of time, for them to be able to appreciate equity markets better, and then slowly start introducing thematic funds, sector funds? Because mind you, these guys there's a lot of josh in them to make fast money, quick money in stock markets. They're young, the first salaries are coming in. Some of them are getting high salaries. So how do you balance the two? They're coming to you with a lot of risk taking, or at least they think that they can take a lot of risk, but better that beginning investor should be introduced first, slowly and gradually, to equity markets before you introduce them to thematic and sector funds. So what kind of advice should personal finance professionals give them at this point in time?
Kesar, clearly, I think those who have come into the market in the last 3 years, especially post-COVID lows, are the ones who have not seen the risk, I would say. While all of them may believe that they are taking right amount of risk and they know what they're doing, I also suspect that many of them, since they have not experienced any large decline or a sustainable fall in the market, really do not know the risk of equity investments in that sense, compared to the ones who have seen larger cycles. While I don't intend to wish them any ill, I would say that it is better to plan for any eventuality. So don't just go by what has happened in the last 3-4 years, which have been very phenomenal. I think even in our career of 25-30 years, we rarely have seen these kind of markets. So it's been phenomenal for investors. Anything that you have touched probably has turned into gold. But there will also be times where things will not work and will not work for quite a bit of time, and that's when your patience will be tested. That's when your risk tolerance will be tested. While everybody likes to get higher returns, and today what has happened is, even if you say that potentially it's a high risk, since that risk has not played out, nobody worries about those potential risks. But I think time and again, as professionals, we need to show the mirror to the investors. Whether they listen to it or not is not the question, but I think it's our duty to make them understand about the potential risks. If they don't play out very well, we'll all be happy as a community. But if it plays out, then they should be aware of what kind of methods to mitigate that risk, whether they have taken right amount of risk or unmanageable risk. All those things will come into question. So I would say, while it is difficult to make somebody more conservative than they are, it's our duty to show them the mirror.
Absolutely. Agree with you 100%. Harsha, we are running out of time. Just two quick questions I wanted to ask you. You've spoken about the merits of entry and exits in thematic funds and sector funds. So two questions I wanted to ask you, and then I'll wrap it up. One is that would you recommend an SIP or a lump sum investment in thematic and sector funds? Which of the two works better? And number two, to be able to for the help of our personal finance professionals to understand some of these thematic funds, to be able to decipher what is the best entry time and what is the best exit time, can you recommend any avenues, or a method, or is there a way to sort of keep a track of which sectors are doing well, which sectors are not doing well, to be able to understand these? How can they improve the understanding and the nuances of individual sectors and themes, to be able to appreciate what is a good entry time and what is the best exit time?
Kesar, I understand. For somebody who is not a practitioner, it would be difficult to understand the vagaries of a particular sector or a theme, or where the valuations are, etc. But as mutual fund houses, all of us have been trying to educate our partners, our investors, by periodically talking about particular themes, sectors, etc. So I think that's one good way of keeping abreast with what's happening in the context of overall markets in each of those themes and sectors, and look for points where probably on a relative basis there is lesser risk. In terms of the other question that you asked, whether lump sum or SIPs, I would say if you're really putting lump sum money, you should pick a theme or a sector which is clearly bombed out and which is at a very attractive valuation, where probably losing money is next to nil. Then probably you have to wait out in terms of the revival of that sector. But otherwise, I would say a systematic investment is better because you can ride out the volatility. Although in a diversified equity investments category, you would probably say that as long as you can do SIPs or STPs, it's good because the longer the horizon, the experience is going to be better. But in case of a thematic or a focus fund, I would say systematic investments, but for a shorter period of time. I don't think you can have SIPs of 10 years and still expect it to do better than the diversified fund, because we spoke about that, right? There will be points of time when it will do well. So typically, I would say the investment horizon should be shorter than a diversified scheme. But I think systematic investment is still better to ride out that volatility.
So a quick question we want to check with both of you. Because you've been knowing Network FP for a very long time. Before we conclude the session, any last words for the community around the series or in general from your side that you want to take it up?
I think it's a wonderful session that you all have taken. It's a wonderful session, and it's good that awareness of around categories are also being taken up beyond the usual large cap, mid cap, small cap, and you're getting experts like Harsha and all to give on ground information and knowledge, and such good data and information that Harsha has also shared in his presentation.
Thank you so much. So any words?
I would second that, Priya. I mean, I think it's a wonderful initiative by Network FP. Large segment of financial planners or professionals would be requiring kind of a refresher course every now and then in terms of what kind of investments one can look at and what it brings to in terms of risk and expected returns, etc. I think a very useful initiative by Network FP.